Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to the community. There is a lot going on in markets at the moment. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. There's a lot to be excited about in markets. There's a lot to, I guess, be nervous about as well, we should acknowledge. But it's important to remember that in hindsight, these market downturns have been good buying opportunities.
Absolutely.
And so we're going to talk about the news of the day and how we're approaching this opportunity. Then we're going to be joined by Mr. Beat Up. God, there's a lot of beaten up stocks at the moment. He has a menu to choose from. What will he be talking about today? And then we're going to close out the episode with a community question on DCAing versus lump sum investing at a time like this.
News and markets.
All right, well, let's get stuck into it, Ren. Bit of an updates on tariffs and markets. We are recording this on April 10th, so we've had some huge swings overnight. But let's start with the latest on tariffs, because that's what it's all coming where it's all coming from.
Yes. So, the tariffs did come into effect, albeit briefly. 2 p.m. Australian Eastern Standard Time on Wednesday, tariffs officially came into effect. To mark the occasion, Trump gave a 90-minute speech where he mocked foreign leaders, said, "I'm telling you, these countries are calling us up, kissing my ass. They're dying to make a deal."
Yeah.
Turns out these countries didn't need to make a deal because, less than 12 hours later, Trump put a 90-day pause on most tariffs, not all tariffs, but importantly still left the baseline minimum 10% in place.
Yeah.
But God, that's all markets needed to see.
Yeah. Absolutely ripping. So we've seen overnight the S&P 500 up 10%, the Nasdaq up 12%, adding trillions back. The ASX also ripping as well. So the market hanging out, thirsty for some good news.
Yeah. It's a reminder of what we said in our last episode, which was just the two of us, which actually coincidentally came out on last Thursday. So the day that we all woke up and saw the market ripped. We said if you miss the best days, you miss out on most of your return. And I do feel for so many people who would have ridden their portfolios down, saw that tariffs actually came into effect and sold because they said, all right, well, Trump is serious about this. It's going to get worse. Would have sold, ridden it all the way down, sold, and then missed that 10% jump up. And we shared that research from Bank of America in that last episode where if you miss the 10 best days of each decade, you miss most of your returns. And that day was one of those 10 days. Like that was case in point, and it was just a coincidence that we released that episode on the same day. But it's the reminder why you have to stay invested. You can't miss the best days because you miss out on most of your return, and you don't know when those best days are going to come.
So don't sell.
Yeah.
Yeah. So look, where to from here? Well, China and US, they're escalating.
Yes.
So we've seen 34% thrown at China. China then came back with a retaliation. Trump then added another 50%.
Yeah.
And that took it to a total of 104.
Yeah, because there was 20 that was already on before
part
this.
of it, yeah. And then China have still said that they're going to literally fight to the end. The US has thrown a total of 125%.
No, you missed one escalation there. China then upped it to 84%, and then the US went to 125%. And honestly, between the time that we record this and the time that it goes out, we may see further escalation, or they may it may all come away.
Yes.
But right now, it's not good for Australia. America's tariffs weren't good for Australia, but Australia's exports to America weren't massive. But a weakening of the Chinese economy, an awakening of Chinese business demand and the Chinese consumer, that is what should be more worrying for Australia. We've literally got a trade war between our closest ally and our biggest trade partner. So I think you could see the reaction in markets from that, particularly with the Aussie dollar. It dropped below 60 US cents. And that's really a reflection of concern that China will be buying less Australian products and therefore will be buying less Australian dollars. Although everyone's feeling good, at least as we speak, because the US market ripped and it seems like Trump took a back seat on some of this stuff, the China stuff should be front of mind for Australians.
Yeah, I wouldn't say I'm feeling great. All he's done is prolonged a period of uncertainty for me. It's like he said, we're going to pause these tariffs and I'm then going to make sweeping statements over the next 90 days about which countries have come to the table to negotiate, which haven't. And we're just going to continue to see, I reckon, some serious volatility until we get to this 90-day point and you might turn around and say, all right, it's all back on. So
yeah, but no one loves kicking the can down the road more than the Trump administration.
Yeah.
TikTok being banned, they've kicked that can down the road multiple times, another 75-day extension. We've seen the Canada and Mexico tariffs be put on and then kicked down the road. I wouldn't be surprised if we get a lot of 90-day extensions here.
Yeah, which is frustrating, to be honest.
So one last thing about markets that I think it's just worth calling attention to, it's like a watch out at this point. The bond market behaved kind of weirdly last week and it is worth keeping an eye on it because bond markets have a habit of toppling governments. And we're about to speak to Mr. Beat Up, who's from Britain, and he would remember Liz Truss being booted out of power when the bond market got unhappy. There was a whole theory that this whole weakening the economy was a effort for the Trump administration to push rates down because the US government has trillions of dollars of treasuries that are coming due this year, which means they need to reissue them. And so they wanted to get rates as low as possible for that. But the bond market didn't act the way people expected it to. Bond prices went down and yields went up. The theory was a lot of traders were dumping bonds, but people had actually assumed that there would be a flight to safety to bonds and prices would go up and yields would go down, which is what the Trump administration wanted. So if US Treasury yields keep going up, that's going to be a big red flashing warning sign for the White House, and it's just something to watch. Yeah.
A lot to keep ahead of. I guess to close it out, Ren, what have you done to date?
Yeah, so we spoke about in the last episode how these things can turn quickly and we didn't want to miss the moment. So I bought some Alphabet and some Eli Lilly, and I also bought some Macquarie here in Australia. Macquarie was down 28%, trading at a price to earnings of 17. If you did a valuation, it wasn't like super cheap. Putting it into like a DCF, the market still was expecting it to grow pretty quickly, sort of 10% a year over the next 10 years, grow its earnings. But that's kind of how fast it's grown over the past 10 years. And I think that was my overriding feeling with a lot of the stocks I was looking at. It's like nothing was particularly cheap. It just wasn't looking as crazy expensive as it did. You know, Eli Lilly was still trading on like a 60 times price to earnings. But I didn't want to miss the moment completely. So I bought some of those three companies. I've still got some dry powder, but you know, from where we're sitting today, like the market made up most of what it lost over the past week.
Sort of.
It's down. It was down like
Not
3%.
quite.
The US is down like 3% in a week. What about you?
Yeah, so as I said on Monday, so I've topped up my core twice now, day 2 and day whatever yesterday was, or at the time of recording yesterday, because I just look back at COVID and things move so quickly that for me, it's just like when these sort of unprecedented drops happen, I get in. I also have put in money into the ATEC ETF I own. It was down 30%, home to some of the sort of tech companies here in Australia, WiseTech, Xero, Car Sales, Pro Medicus. And topped up Eli. I also put a bit into Bitcoin.
Okay.
Yeah, because it was down in the sort of 77s at the time. Still have some powder on the side, but the feeling was, as you kind of mentioned, things happen so quickly. I don't want to look back in 2 years and regret not getting in without knowing what's coming, but some good opportunities. Yeah.
So I think if people are tuning in and they're wondering how we're thinking about this moment, how we're playing this moment, we're not being Pollyanna-ish about this. Like we're not saying everything's going to be fine, don't need to worry about it. This could last a long time. I think the average bear market lasts months, not weeks. But in hindsight, these have all looked like good buying opportunities. That's what we keep reminding ourselves. The last episode we included in our show notes some quote from Shelby Davis. Most of your money is made in bear markets. You just don't know it at the time. I think that's the message we want to get across. That's a message we're trying to internalize ourselves, because it can be scary and you can feel like it's time to get out. My dad actually called me last week and said, should I be selling stuff in my super?
Oh my God.
But you got to remind yourself to stay the course. I mean, when the market jumped 10% in a day, that's a reminder of why.
Yeah.
Because you don't know when things will turn and you don't want to miss out on the turn.
Yeah. To keep up to date with all of the headlines, though, that are absolutely moving markets at the moment, make sure you subscribe to our daily newsletter. There'll be a link in the show notes below. We summarize all of those headlines that we think are important to your investing journey, delivered to your inbox 6 a.m. every day. And if you want to listen to those headlines, we have a podcast called Headlines by Equity Mates. It'll be in your podcast app now.
Mr. Beat up. Mr. Beat up.
I have the beat that describes that moment accurately.
Back by popular demand, we have Mr. Beat Up here looking at companies that are down but not out. And today we have a cracking company for you. Mr. Beat Up, or Simon, welcome.
Thank you. Good to be here. It feels like the frequency is getting...
As I said, back by popular demand.
I mean, if you're not going to be back in when the markets are falling as much as they have, what is Mr. Beat Up for?
We should have done this 2 days ago.
I know. Well, if you've just joined the show for the first time, Mr. Beat Up here comes in with stocks that have been absolutely pumped by markets, but perhaps unfairly, and we're going to look at why they're down, but why there might still be a pretty decent investment thesis behind it.
Yeah, I think we covered the criteria last time, but Simo, just correct me if any of this is wrong, but like down more than 40%. The market has overreacted, so like the fundamentals are still there, and there's growth prospects into the future.
Yeah, all that stuff, could be leadership issues, missing financial expectations, just bad news. But the general feeling is the market's overreacted and long-term value is still there.
Well, sometimes it's not the general feeling. Sometimes it's your particular feeling.
Mr. Beat Up's general feeling.
Yeah. Because often the market disagrees with you, but you've built a pretty good track record, which is why you're coming on more and more frequently.
Okay, pressure's on.
Pressure's on.
I mean, markets have been down. How have you been thinking about it, or what have you been saying?
Yeah, well, the short list was pretty long for this episode. So Google Alphabet was flirting with a 30% drop. Not quite Mr. Beat Up territory yet, but one I'm definitely watching closely. Honorable mention to AMD, Advanced Micro Devices. They're a global semiconductor player. There was a lot of buzz on X that people saying this was deeply undervalued. Interestingly, it actually popped 24% today. But they were down nearly 60% from all-time highs before that. But I do have one stock I want to focus on today, and I'm wondering if you guys can guess it. The CEO has actually been on the show before, has the same haircut as Ren.
I know what company you're talking about. So do you want me to guess?
Coinbase.
Yeah. Should we bother doing this guess then?
Yeah, keep this all in.
Yes, you're right. We have interviewed Brian Armstrong. Was his name?
Yes, Brian Armstrong.
Yes.
He's CEO.
Yeah.
And the stock is Coinbase, Nasdaq ticker COIN, Coin.
Nice. Now, for people who are unfamiliar with Coinbase, it is a crypto company. It's a crypto exchange, but it does a whole bunch of crypto services. I think it's the largest crypto custodian in the world now. So all these crypto ETFs, it's holding that crypto and getting paid for that. I guess it's like a crypto investment bank / services company, financial services company.
We're getting to my thesis, but a lot of people still think it's just a trading platform, but it's actually doing a lot more in that space. But I guess if we just start with the damage, so actually up 17% today, but they were down nearly 60% from their all-time highs in December. They got to about $350, down to 150, about 175 today, so still down around 50%. And just to give you a flavor, Q1 was their worst stock performance since FTX collapsed in 2022.
Oh, wow. Nice.
So it's been hammered. And I guess why? Well, 60% of its revenue does still come from trading volume. Bitcoin, we know the story there. It's down quite a lot from its all-time highs, around 20%. Ethereum's been battered about 50% year to date. When crypto's cold, Coinbase's revenue goes cold to an extent. And then you got the macro punches. We've been talking about it this episode already. There's a risk off in the market, lots of uncertainty. So we've seen some investors flee to safety and, high beta stocks get punished. And I guess the final thing, there's still quite a bit of regulatory uncertainty in this space. There was some good news. The SEC actually dropped its enforcement case against Coinbase in February, which had been going on for 2 years, a battle with them about unregistered securities. But there's still no final framework for crypto in the US. So this uncertainty has caused hesitation for investors. So bit of a triple whammy, slumping crypto market, risk off share market, and still regulatory question marks.
So I don't know if there's regulatory question marks while Trump's in power. It feels like they're embracing crypto as much as they possibly can. But you're right. There's been a lot of, uncertainty around crypto. So why do you think it's been over-punished?
The market's dumped Coinbase like a bad meme coin, but I think it's anything but a scam. And if you look here, just to start with, the long-term tailwinds and their trusted brands. So crypto isn't going away. Global adoption is rising. Individuals, institutions, even governments are getting more involved. The industry's often been clouded with questionable players, and Coinbase really has emerged as the trusted name in crypto. And Brian Armstrong, he's seen really as a steady hand in an otherwise chaotic industry. He's regulatory minded operator, building for long term, not chasing hype. And established institutions clearly trust them. We've seen this massive rise in ETFs in Bitcoin, and Coinbase is currently providing custody for 90% of those in the US, including the biggest one of all, BlackRock. So that's a massive endorsement. They're no longer just a retail exchange. They're becoming critical infrastructure for Wall Street's move into crypto as well.
My question with this before we go on to the tailwinds though, is this just not a stock that really follows the Bitcoin cycle?
Yeah, it's just a leverage bet on Bitcoin.
Yeah. Do you know what I mean?
Well, this is my next point, really, is that it's not just a one-trick pony anymore.
Okay, you make the case, I'll make the counter case, because I'm going to say it is.
Okay, so
you could probably, I'm trying to overlay the chart, but
it definitely is correlated, because when there's fear and uncertainty in crypto, activity drops. But 5 years ago, 90% of their revenues came from trading. Now it's 60%, and they're trying to get that lower and lower. And really what it's trying to do, it's trying to build critical infrastructure for the entire crypto economy. So this can get quite technical, but I'll rattle off some just to give a flavor of some of the things it's doing. We've talked about the custody storage there for things like the ETFs and big fund holdings. That's growing massively. They also offer staking now. So think of that like earning interest off your money in the savings account. You lock up some of your crypto. That helps support the blockchain operations. And then you get rewards or interest in return, and Coinbase get a cut of that for enabling it. They also have, they developed a base layer, which goes on top of Ethereum. So that's basically designed to make transactions quicker, cheaper, and still have the security of Ethereum. So think about like a toll on a road, on the digital payment system. And then another massive one is USDC. So they've co-developed this with Circle. This is a stable coin. Think of it like a digital twin to US dollar. So $1 equals 1 USDC. They have now 25% of the whole stablecoin market, 60 billion in supply in USDC. That's being widely used for trading, digital payments, decentralized finance. And last year alone, they made $910 million just by people using that. So the income isn't completely tied to trading volumes. I think the big idea here is that if crypto goes mainstream, Coinbase, they could become the Amazon Web Services of this space. So like AWS powers the internet quietly in the background, Coinbase is trying to power the crypto economy behind the scenes.
So Bryce's question wasn't, is it tied to trading volume? Bryce's question was, is it tied to Bitcoin? And it is, because all of those things are like diversified ways to make more money from the crypto economy going mainstream. But it is just a question of like mass adoption of crypto. I don't think it's a bad bet to make, but like we should be clear-eyed about what the bet is.
Yeah, I think if you have strong views about Bitcoin and crypto, stay away. I'm a believer in this space.
I guess that's what I'm saying. Like it relies on, like you said, crypto going mainstream, for example.
Yeah, they're trying to place themselves as being the foundational infrastructure to drive mainstream crypto adoption.
Yeah, I don't even think it's a question of trying anymore. I think they have positioned themselves there.
Yeah.
The question is now just like, are non-crypto people going to start using it?
Yeah. Good question.
So give us just a quick look at the financials and valuation, because you've said it's been beaten up, down more than 50% still, but is it cheap?
Yeah, well, I've looked at the financials and it's pretty good. Like it's profitable. It's
that's
growing.
surprising for crypto.
It's global. So the revenue doubled last year, 3 billion to 6 billion. Obviously, crypto had a really good year, so there's a story there.
Yeah.
But looking at, you just give a plug, I guess, to get started investing. You did the kind of 4 steps to picking stocks. Some of the financial metrics you looked at in there, like return on equity, 31%. So that gets a tick. Reinvesting around 60% of its cash flow into growth. Big tick there. Profit margins are currently about 60%, and they're now in over 100 countries, 98 million people using the platform. It was trading at a 15p to E before today. It's now around 18. So the market's freaking out a little bit over crypto's recent dip. If you do believe in the future of crypto being a bigger part of our lives, this could be one to check out. Brace yourself. It's probably going to be volatile. I think I'll be dollar cost averaging in from here.
For me, though, when I think about this, it's just like, if you believe in crypto, isn't it the play just Bitcoin?
I don't know. I like those numbers. That's the thing that convinced me more than anything. 100% revenue growth rate, 60% profit margin, 30% ROE.
Yeah, well, let's see what the revenue is this year.
60% of its cash flow.
How consistent is that revenue growth?
Take the
I bet that revenue growth is pretty cyclical.
It has.
I like how you've cherry picked 1 year.
But I think the key thing for me is that in previous years, that 90% was trading volume. Now only 60%.
I think
so
it
should smooth out somewhat, but it is still heavily tied.
Yeah, definitely.
Yeah. All right,
Nice.
love it. We'll put that on the Mr. Beat Up watch list. Coinbase, what's it trading at now?
$175.
Okay.
We should also say that we'll put a link in the show notes to that checklist that we spoke about on Get Started Investing. It's a 4-step checklist to analyze any company, and Mr. Beat Up used a few of the metrics there. We'll make sure we put a link in the show notes to that. Thanks, Simon.
Thanks,
Great to be here. Cheers.
If you have a stock that you would like Mr. Beat Up to have a look at, to review, to get his thoughts on at a time like this where there is plenty of opportunity out there, hit us up, equitymates.com/contact, and we'll add it to his list. As we said, we'll bring him back as long as the demand is there. That frequency will only continue to increase. So thank you so much, as always, Simon. We appreciate it.
Cheers. Thanks, guys.
And as we go into an ad break, we should say, if you want to keep up to date more day-to-day with crypto, we have a sister podcast, the Crypto Curious podcast, so you can head over there wherever you're listening or watching to this.
Let's ask the community.
Hey, Equity Mate.
I just had a question.
Hey, Bryce, I've got a question.
Answered.
Welcome back to Equity Mates Investing. Markets are down, so it is certainly a buying opportunity. But the question that we have today is, should we put all of our cash in, or should we dollar cost average?
And this conversation was sparked by a question from Casey.
Hi guys, firstly, thank you so much for all of the content you put out. It's really helpful and digestible, so thank you for that. I was just wondering what your guys' thoughts are on lump sum investing during a market downturn. I usually dollar cost average into diversified ETFs, but recently with the Trump tariffs going in and during previous market downturns, I've lump sum invested into those ETFs. I know you're not supposed to time the market, but it feels like a missed opportunity if I don't buy the ETFs I usually buy when the market's down. I was just wondering what your guys' thoughts are on this. Thank you so much.
Great, love that.
Love the question, Casey. If you want to ask a question, there's a link in the show notes or the YouTube description. You can write to us, but we'd love it if you recorded a voice note like Casey. So, Bryce, where do we start? Lump sum investing or DCAing?
Well, I think we should start with the fact that if you do have bit of a cash pile on the sideline, this is the time, as Casey has said, to get excited about it. We've spoken about on the show over the last few weeks that these opportunities don't come around all too often. And so it is time to put your money to work.
Yeah.
But I think people do get confused when we say or listen to Casey and say, we don't have an issue with lump sum investing in times like this, but also don't try and time the market.
Yeah. So when we're talking about don't time the market, it's really, it's more about selling than buying, or it's about selling and then trying to buy again. And so the reason we say don't try and time the market is because if you sell and you get out of the market, chances are you're not going to nail the timing to get back in. No one, like even the best investors of the world, haven't shown a consistent ability to time the market well. And so who are we to think that we could time the market well? And the problem is when you're trying to buy and mainly sell, but then buy and sell, and try and trade your way through a market cycle, you miss out on those good days. You missed out on the majority of your return. You incur trading costs. You also just add a lot of stress to your life. So you're worse off financially. Your mental health is worse off.
Yeah, big time.
There's no reason to try and trade the ins and outs of the market. That's different to if you have cash on the sideline and there's a buying opportunity.
So I think long story short is we both have put money in. We've been opportunistic about this point in time. And so I think to directly answer Casey's question, I think what she is doing there and recognizing that there is an opportunity and putting money into the ETFs that she's already been buying is great.
Yeah.
Like if you have the ability to do so, great.
Yeah. I mean, everything Casey said in that question was like exactly how you should think about long-term investing. Have a consistent DCA strategy for whatever the market is doing, and then being opportunistic when the market is down and putting more in. Like that is great. Just keep doing that, Casey, and you're gonna do well.
And if you're sitting here being like, damn, I'm missing out because I don't have that cash pile available. A, lesson learnt. Try and make sure you do have some cash pile available. But also B, don't change your consistent dollar cost averaging strategy if you had one going in. Leave it. You're going to catch the market as it falls, and as it comes back out the other side, you're going to catch it as it goes back up. So whilst you feel like you might be missing the opportunity, you're actually not. This is the exact reason that you do dollar cost average, so that you can buy more on the way down.
So then the second part for Casey is, okay, so she's got this lump sum and she wants to put it in while the market is falling. But we don't know how long this market downturn will last. Like COVID was a classic example where it bounced so quickly that a lot of people missed the bounce. But then again, you don't want to buy when the market's fallen, 20% if it's going to be down 50% like the GFC 6 months later. You want to get it when it's down 50%. And so how I would answer this question is have your lump sum, whatever it is, and split it into smaller chunks and almost like do a mini DCA where say, if I've got $10,000 on the side over the next 5 months, I'm going to put $2,000 in each month. And so that way you're not trying to perfectly time the bottom, but you're just deploying that lump sum in a relatively short period of time. And maybe today's the best it's ever going to be. Maybe in 3 months it'll be down lower, but you're sort of getting whatever the average of this downturn will be. So that's how I'd think about it. Obviously,
what about for individual stocks? Is that how you would do it?
Individual stocks, I think it's more case by case, more opportunistic. If you wanted to put a big chunk of money into like one individual stock or a couple of, you could do it that way as well.
But I think overall the takeaway is whatever cash, it's like deploying all at once early on in these moments is probably not the best idea.
I mean, it's not the worst idea.
Yeah.
Like, there's nothing wrong with doing that. If it's like market's down 20%, put it all in. That, like, great. Yeah. Like, there's nothing wrong with that.
But know that that's it.
But if the question was how I would do it, because in my mind, I'd be worried I'm not getting the best moment. And so, for everything we say about don't try and time the market and all of that stuff, you still want to feel like you've nailed it.
Of course.
And structuring it that way would just make me personally feel like I've put some money in at the right time whenever that right time would be.
Yeah.
What about you?
I'm slightly less. This time around, I've been slightly less strategic on deploying cash from like a DCA point of view. So, firstly, what I haven't done is I haven't changed my original DCA setup. That's just. It is what it is.
Yeah, and that's the same for me. The original DCA is just continues.
That's just continuing. So then I've got this cash on the side. And again, I keep referring back to COVID, but I feel like in instances gone past where we've had this opportunity, I've waited too long.
Yeah.
Because I've felt like everyone says, just see how it plays out. And I have kind of missed big opportunities to get in. So whilst I'm still absolutely have no certainty on where things are playing out, I've put in lump sums, but don't have like a strategy of, it's going to be once a month for the next 3 months.
Yeah.
I'm just like, shit, market's down 10% in 2 days. I'm going to take that opportunity.
Yeah.
Market's down another 5%. I'm going to take that opportunity until I effectively run out of cash.
Yeah.
And then I realize, and then I can kind of sit back and say, look, if the market falls further from here, so be it. I know over the long term it's going to improve, but at least I've deployed more money than I had if I was just sticking with the DCA at a time where there was opportunity to do so.
Yeah.
So yeah, for me, it's not all at once, but I'm not sort of sitting back and saying I'm going to split it evenly over a period of time. It's just like opportunistic.
So Casey, to round out your question, I think when we say don't try and time the market, it's more about getting money out of the market and then going back in. But we will never object to people putting more money in the market.
No, at any time.
At any time. Yeah. And don't invest money that you're going to need.
Yeah,
we should be clear about that.
That's actually a very good point, because I've seen some commentary in the Facebook community group about people selling bits and pieces and taking on a bit more risk because they're feeling like they're missing out. If you don't have the money available and you're putting money in that you are going to need beyond investing, don't do that.
Yeah.
Do not do that.
Yeah, you just set yourself up for risk. If the market keeps falling and you have to sell it to cover rent, or you're planning on going on a holiday and then all of a sudden you've got less money and so you've got to get a credit card to cover the holiday, whatever it is, like just don't take that risk. But if you've got dry powder on the side, if you've got money that's earmarked for investing and it's been waiting for the right time, well, now's the time.
Love it. Well, Casey, thank you so much. As Ren said, we really appreciate if you can leave us a voice message. So there'll be a link in the show notes or the description below. Otherwise, you can write to us and leave us a question at equitymates.com/contact. But that brings us to the end of another jam-packed episode. So much happening in markets at the moment. Join us in the Facebook community group. Follow us on Instagram. We are releasing information as we get it, and you can track how we are approaching our investing journey almost in real time in some of those other channels. But Ren, it's always good to chat. We'll pick it up next episode.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.